Sullivan here for the Credit Guy TV. I'm a special guest blogger this week over at the At Any Rate blog at Ross Mortgage. And they asked me to talk about how a student loan can impact the loan process and really impact your credit score. Many students now, according to Forbes, graduate with $26,000 in debt or more. And it's very important that you handle that correctly, because from a new credit perspective, you're starting out with probably a thin file already. And when you have just student loans, it's very important that you treat them properly. So what we're going to talk about first is to get a consolidation loan. You see, many times you'll have a new loan for every term that you were in school. So you've got like 10 or 11 accounts that are all maxed out, that all are very high as far as the credit utilization goes. And you want to maybe minimize that impact, and the best way to do that is to get a consolidation loan. If you get a consolidation loan, you can take all those 10 accounts and make them one account. And you're much better off from a score perspective if you have just one account that's maxed out as opposed to 10, especially when you might only have one or two other accounts outside of the student loans at this time. So it's very important to go back to whoever holds your student loans and ask them for a consolidation loan. Many times it will save you money on interest rate and payment. So that's the first step. The first thing you should do is, as soon as you graduate, is to get a consolidation loan from the bank that holds your note now, or the government. Whoever holds your note, go back to them. It's really not that difficult. It's a fairly simple process. But as soon as you get that, the next thing you do is apply for a deferment. When you apply for a deferment, that gives you time to kind of get on your feet right after college and start to make a little bit of money before you have to worry about your debt load from the student loans. But what I would tell you is very important to continue to make payments. Even though you think the deferment may start in June, you need to pay on your regular payment schedule past that deferment date, because many times the deferment date is not recorded properly, and then you wind up with a 30 or a 60 or 90 day on this new account. You want to avoid that at all costs. So you want to continue to make the payments past your deferment date. And that will also help you by bringing down the high credit just down below 100%. It's a win-win from that perspective. So get the deferment and then make the payment past the deferment date. So the next step for new graduates is to make sure that they have 3 to 5 credit cards open and active. Now, hopefully you've already got 1 or 2. If you do, make sure that you keep the payments on time on those, but you're going to want to add a few more. And some people tell you to spread out the credit card applications. That is probably not good advice. If you're 6 months or more from getting your mortgage, I would tell you to get a few credit cards right now from the big banks. Don't go to big box stores to get the credit card. Go to the big bank. You'll get the most amount of points from those, and then after 6 months, they'll really start to contribute towards raising your score. And a lot of people want to say, oh, you should get a budget and stick to it, and that's good advice. But I would tell you to look at your expenses and see if you can't cut back on things like, everyday expenses, not necessarily the things that you enjoy, but the things that you have to pay. Do you really need cable TV? Do you really need the best phone plan? Look for areas, or insurance. Look for areas where you can cut back, where it makes sense, so that you're not on such a tight budget, especially after you graduate and you get that first job. Things are going to be kind of tight. Don't go crazy thinking you can now spend all kinds of money, especially if you start doing it on credit. It's not a good idea. So from a mortgage application perspective, the debt on a student loan is treated differently depending on whether it's conventional or VA or FHA. If it's conventional, the debt payments on that student loan are counted whether it's deferred or not. So the minimum payments that you have to make on the student loan, even though you may not have to make them, still go into your debt ratio and can make it more difficult to qualify for a mortgage. If you're going FHA or VA and they're deferred for 12 months or more, they do not need to count, or they don't count towards your debt load. So FHA and VA are a little bit more forgiving, but again, the deferment has to be more than 12 months out. I hope that helps, and I appreciate Ross Mortgage allowing me to guest blog on their At Any Rate blog. So you, with a little bit of me and Ross Mortgage, we're going to change the credit industry. Thank you.